All right. Today is Wednesday, July 20th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. It's going to be a short and sweet one, but still packed with information. We're not going to do the In Focus segment, but I have few comments here. The problem for the bulls who are hoping for a summer rally, yes, the stage is set for a summer rally, but there is a problem. Every time the stock market moves higher, there is a ceiling, specifically for the most wounded, most damaged stocks. I'm talking about stocks with lousy balance sheets, stocks of companies that will go bankrupt or default on their debt if interest rates move significantly higher. Among these companies, cruises, for example. And unfortunately, we have a slice of the retail investors who love so-called bargain hunting. In reality, they're not really bargain hunting. They're going down in the sewer looking for an investment idea, looking to get rich from the sewer. And the clearest example of that is retail investors getting sucked in these short covering rallies when they happen in these very damaged garbage stocks. This week so far, we got a lot of these stocks catching short covering rallies. Among them, cruises. We talked about cruises and the risk in investing in cruises in details in a previous video, but nonetheless, we see this behavior of buying the dip in cruises. This week, we got a piece of fundamental news that initiated a short covering rally in cruises. And this piece of news is the CDC announcing that they're ending their grip on cruises. And right away, we saw a short covering, and then came the retail crowd the very next day, and they bought these names thinking that the bottom is in and the worst is behind us. But here's the problem. Every time these stocks rally significantly so, they present an opportunity to management to raise cash, meaning they dump more shares on the top of the heads of the dip buyers. And this is exactly what we got today in Carnival Cruises, the ticker CCL. Right after the bell, of course, they had to wait till after the bell to suck in all of these dip buyers, and they announced that they're selling $1 billion worth of shares. And right away after the bell, the name went down so far, as I'm seeing right now, over 9% to the downside. Now, yours truly, the guy you're listening to right now, did buy put options on CCL, but it was a wild shot. I did not know that they're going to sell $1 billion worth of shares after hours. Otherwise, I would have put more money into it. But my thesis was technical in nature, which we're going to discuss in the charts analysis. But the problem goes beyond cruises and the crypto exchange names such as Coinbase, etc., etc. The problem goes for the entirety of the market. The market simply cannot rally in a sustainable fashion. It cannot rally impulsively so without hitting a ceiling. You see, with Carnival Cruises, the ceiling is every time the stock shoots up higher, management is going to sell more shares to raise cash because they need the cash. Otherwise, they go bankrupt. When it comes to the market, the ceiling is every time the stock market shoots up higher, impulsively so, that gives the Federal Reserve the excuse to raise interest rates even higher and be more aggressive with a tightening policy. And that puts a ceiling on any rally. This is the problem that we're at right now. The expectations for next week's Fed's meeting is for a 75 basis points rate hike. But if the stock market rallies too hard, too fast into the meeting, we're going to have a problem. The Fed is going to look at the action and say, you know what? We got the cushion that we need to go aggressive right now and slide in a 100 basis points hike. And that would put an end to the rally and initiate a reversal. We talked about Jerome Powell with the whack-a-mole. Every time the stock market pops its head higher, here comes Papa Jerome with the mallet. Boom, 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 smacking your little head. And this is the risk in this market right now. If you're buying the dip as an investment, not a trade, you're assuming a lot of risk because of this ceiling. When will the ceiling be at least lifted higher? Well, when we see inflation moving down in a significant manner. For now, maybe inflation is peaking, sure, but it is sticky. We're seeing oil and gas prices moving higher again. The demand in the economy is simply too high, and the demand is not going to cool down in this economy unless we start to see unemployment rising higher. We talked about that numerous times in this program, so I'm not going to be redundant here. And with that out of the way, let's move on to cover the stock market activities today. We start with the closing of the major indices, and here we go. The Dow Industrial Average closing in the green by 47.49 points, or a gain of 0.15%. The Nasdaq also in the green by 184.5 points, or a gain of 1.58%. The S&P also in the green by 23.21 points, or a gain of 0.59%. The sector's performances today led by number 1, capturing the gold medal, technology. At number 2 for the silver, communication services. Number 3 for the bronze, consumer cyclicals. And the laggards of the day led by utilities, healthcare, and defensives. Now I have a hunch that we will see the opposite picture soon. If we have a pullback and this rebound starts to frizzle, you're going to see utilities, healthcare, and defensives back on top again. What about the advance to decline ratios? NYSE 65% advancing versus 31% declining. The Nasdaq 69% advancing versus 26% declining. And the breadth was pretty good today. No doubt about it at all. Look at the new 52-week highs versus the new 52-week lows. We're getting 32 new highs versus 39 new lows. We haven't seen the gap narrowing to this magnitude before. And that tells us that we have the ground, we have the setup for a summer rally. The problem is that ceiling. It's here, and it's not going to go away until the Fed decides to do the 75 basis points, and then it goes silent all the way till September. And that will allow the stock market to rally from that point on all the way till September. The problem is if it rallies too hard, too fast right now into the meeting, and then the Fed does 100 basis points, and then here comes the speculations that the Fed will do another 75 or 50 in September. Maybe we'll do an emergency meeting in August, and the stock market is not going to like any of that. Moving on to commodities, energy futures were to the downside modestly for crude, the WTI and Brent losing around 1% for the WTI, a little over half a percentage point for Brent. Nothing big here. The RBOB gasoline, on the other hand, lost a little over 1.5% today, while heating oil was muted, be it negative. Yet the story remains natural gas. Here it is once again. A massive rebound in natural gas, gaining over 8.25% today alone. And nat gas is now closing back at $9 per BTU. Big problem across the Atlantic and Europe. They cannot find any supply of natural gas. We have a problem here in exporting natural gas because of the Freeport LNG facility. That's not going to be back until October. And of course, the Russians are playing their hand. They know the weakness. They know about the Freeport LNG, and they're squeezing European heads right now. There are a lot of conflicting reports about Nord Stream 1. Is it back? Is it not back? We'll see what happens by the end of the week. But there is another problem in Europe. The recent heat wave is causing commodities prices to rise higher again, specifically aluminum and zinc. The headline reads, Europe has lost about half of its zinc and aluminum smelting capacity within the past year, and a further surge in power prices could knock more plants offline over the winter. And today we saw zinc and aluminum prices moving higher again. We have the stock of Alcoa, which reported after the bell. The stock is surging higher. Last time I checked, not only because they beat on their earnings, but because we have aluminum prices moving higher again due to the heat wave in Europe. If the energy crisis continues, we see rationing, this is going to be even bigger problem. Natural gas prices will move higher, but also aluminum, zinc, iron, and this will make the cost of manufacturing move significantly higher. Back to the futures, what about softs? Lumber continues to lose ground here, losing about 3% today, along with OJ down by about 2%, along with sugar, which lost about 1% today. On the other hand, we have positive activities for cocoa, cotton, and coffee futures, be it modest gains, all under 1%. Metals, right across the board, gold down, silver down, platinum down, palladium to the downside, be it muted, and the reason is the dollar moved higher again. On the other hand, copper moved higher the second day in a row because copper got very oversold. So for now, we're seeing an oversold rally. Can we see a build-up on that or not? And by the way, when we talk about a ceiling for the stock market, there is a floor for copper because the demand for all of these EVs, that requires a higher output of copper. So there is a floor in copper prices. They're not going to go down indefinitely. What about meats? Muted across the board for live and feeder cattle futures, but look at this. The new big tech, lean hogs, surging higher again and scoring gains of almost 1.75%. Check out the chart of lean hogs, by the way, year to date. All of you chasing cruises and airlines, RKK, Tech, Tesla, AMC, GameStop, you're not doing so hot so. But if you're chasing the new big tech lean hogs, you look at the chart. Anyways, what about grains futures? Down big for the day, specifically for soybeans and soybean meal futures. Soybean down by more than 8% today alone. Soybean meal futures down by almost 6.25%. Soybean oil down by almost 5%. We will also have losses for corn, canola, and rough rice, be it modest gains in comparison with the losses in soybean. Yet the outlier is wheat futures gaining a little over 1.25% for the day. Wheat futures went down big from the top, losing all ground year to date, but the prices of wheat remain elevated and the tailwinds pushing wheat prices higher are still here. And therefore, we're not seeing the end of this inflation yet. Inflation remains too high, even if it is peaking. Moving on to the big casino, the options market. What's going on here? The volume is improving by a little bit, but the put to call ratio, not really. We're seeing it improving in certain names, but all in all, there is still a hesitancy in the market, a lack of conviction in going all in buying call options. Regardless, Amazon came up number one, and I've been talking about Amazon since last week, buying call options in this name. So far, it's scored big gains in the last couple of weeks, but perhaps we have a short-term top here in the rebound rally. We'll talk in the charts analysis. I'm going to cover Amazon. But regardless, it came up number one with around 1.4 million contracts traded today. About 60% of those were calls. At number two, Apple at around 1 million contracts traded today. About 53.5% of those were calls. And at number three, NVIDIA. The Pelosi trade remains hot, for now at least, and the name traded around 950,000 contracts today. About 64% of those were calls. And pay attention now. Rumor has it, little birdie told me, that Mr. Pelosi closed his call options. So be careful here. Moving on to the unusual activities that took place in the options market today. We start with the ticker F for Ford. The name announced today, laying off over 8,000 employees. This is yet another result of the EV lunacy, and somebody's betting for more pain to come for Ford. Although, at least where I live here, I'm seeing a lot of new Broncos all over the place. When I asked my neighbor, what about that? Because he got one. He said, I placed an order last year, and the car just arrived this week. Now, he's thinking about flipping the car because there's a lot of demand for Broncos. He can actually make a sizable profit from selling the car. But anyhow, for this trade, they bought the $12 puts for the expiration date, August 26, with expectations that Ford could go down by more than 6% by then. They paid around 50 cents apiece to enter this trade, all in all spending around $4 million. What about the ticker INTC, Intel? The CHIP Act passed. We're done. So are we going to have sell the news? At least somebody betting that will be a case. And they bought the 38 puts for the expiration date, August 19th, with expectations that Intel will move down by more than 6% by then. They paid around $1.10 apiece to enter this trade, all in all spending around $3 million. What about the ticker NFLX, Netflix? It went down in the morning, then it went up again. And by the way, I closed the entire trade that I talked about yesterday. I closed the short leg with the expiration date of this week, Friday, the 210. The moment Netflix went down, closed the gap. I closed those for $3, around $3 a pop. Then I let the long leg, the 210 for the expiration date of next week, ride all the way till the end of the day, and I closed those for about $11 a pop. So all in all, I made about $8 a pop, but I paid $1.60 a piece to enter this trade. So all in all, I made about, let's say, around 700% profit. Not bad. But somebody now is betting that Netflix will move down by the end of the week, and they bought the 205 puts for the expiration date, July 22nd, meaning this Friday, with expectations that Netflix will move down by more than 5% by then. They paid around $1.10 a piece to enter this trade, all in all spending around $900,000. Continuing with interesting trades, what about the ticker COIN, Coinbase? Believe it or not, it rallied by more than 40% week to date. We're talking about in 2 days. But perhaps we're reaching a top here. We got the bad news after the bell that Tesla sold around 75% of its tulip holdings, and therefore Bitcoin went down slightly. And the assumption is Coinbase will also go down tomorrow. So somebody bought the 65 puts for the expiration date, August 12, with expectations that Coinbase will go down by more than 13.5% by then. They paid around $6.20 a piece to enter this trade, all in all spending around $3.3 million. What about the ticker HD for Home Depot? We covered the chart, I believe, over the weekend, the weekly chart, and it looks good. It looks like Home Depot is primed for a rebound rally. But is it already done? Because now we have this trade of somebody buying puts, betting that Home Depot will go down even further. They bought the 275 puts for the expiration date, August 19th, with expectations that Home Depot has another 9% or more downside to come by expiration date, August 19th. They paid around $3 a piece to enter this trade, all in all spending around $1.6 million. Lastly, what about the trade for the ticker AMZN, Amazon? Excellent performance last week and this week, but it's going to stop at some point. It's getting a little overbought, technically speaking, in the hourly chart, in the 30 minutes chart, which means we will see a pullback. So somebody bought the 113 puts for the expiration date, August 19th, with expectations that Amazon could move down by more than 8% by then. They paid around $3 a piece to enter this trade, all in all spending around $1.5 million. Moving on to the heat map analysis, what's going on here? We have a risk on mode in the stock market. Why do we have a risk on for now? The dollar is down. The 10-year yield is cooling down, at least for now. We have a lot of oversold readings in the charts. We have a lot of short covering. A lot of shorts are booking profits, and hence we're seeing risk on. Risk on favors what? We're seeing software, chips, technology, communication services, the reopening names, cruises, hotels, casinos, airlines, all outperforming today. What is underperforming? The answer is the winners year to date, the risk off mode. What are we talking about here? We're talking about healthcare, insurance, big pharma. We're talking about utilities. We're talking about real estate. We're talking about consumer staples. All of these are down for now. But you watch. The moment we see the risk-off mode frizzling away for whatever reason, you will see rotations back into utilities, into big pharma, into the consumer staples. It all depends on the upcoming Fed meeting and how we enter that Fed meeting. Is the market going to rally too hard, too fast, or is it going to be reasonable before the meeting? Here's some corporate news for you. I don't know if you heard this or not. It's an interesting piece. I tweeted it today. It reads, an ex-JP Morgan gold trader said that his boss coached him to lie about price manipulating orders and later advised him not to plead guilty as prosecutors were preparing criminal charges against top executives. This is the Landromat, the top criminal organization in the country, JP Morgan. They got caught manipulating the commodities market, specifically the precious metal market, and even today we have an understanding that JP Morgan continues to manipulate gold prices down for whatever reason. And here's another piece of news for you from Mattel. Mattel inks a deal with Elon Musk's SpaceX to produce a line of toys. I don't know what kind of toys they're going to produce, but I don't believe this will make a good child toy unless you want to scare your kids. Look at that. Anyways, what about the heat map for the ETFs? Green across the board for the most part, with exception of the defensives, utilities, the XLU, consumer staples, XLP, real estate, IYR, what's working, chips, SOXL, SMH, XLK for technology, but also energy, XOP, XLE, all in the green. Commodities, UNG, natural gas, BOIL, continue to move higher, but precious metals not performing. GDX for gold, GLD, silver not performing, still lagging, as if they're not trusting the move to the downside by the US dollar. And it was a growth kind of day led by the NASDAQ. Growth, the IWF, VUG, outperformed value significantly today. When it comes to internationals, down across the board, led by Europe, I'm going to see more pain in European equities if this gas problem continues. Moving on to charts, and we start with SPY, S&P 500 30 minutes chart. What's going on here? We got another pop higher above the resistance that we talked about yesterday, which is 393.16. The chart's now forming a triangular pattern of consolidation, forming higher lows and lower highs, meaning either the chart's going to pop higher or it's going to break the triangular pattern of consolidation to the downside. Wow, Maverick, are you saying the stock market could go up or down? Wow. Well, I'm not a seer. I don't know how it's going to play out, but if I had to lay a bet, I'm going to use supportive evidence. What is the supportive evidence that I got? The answer is the momentum indicators. Look at the RSI, the MACD indicator. The RSI is in negative divergence. It got overbought. You have the MACD indicator also elevated. What does that mean? It means that the risk is to the downside. If I'm laying a bet, my bet is this pattern will be broken to the downside. And perhaps we will see a loss of the support 393.16. That doesn't mean that the rebound rally is over. We have to see more damage to reach that conclusion. And we're not going to reach it from a 30 minutes chart. We have to move on to the daily chart for the continuous contract for the SPY. For now, the chart is battling the resistance at around 3,960. Is it crazy to say that the chart could pull back, gather some more energy before it pops higher again above that resistance? Not really. It is plausible. The bottom line is, can the chart close the week above this number, 3,960 or not? If it does, major victory for the bulls. If it doesn't, and if the chart loses 3,855 as support, major victory for the bears. Yet the bulls don't want to see the chart reaching 4,100 by the end of the week. Why? Because if the chart shoots up that high, that fast, the Fed will look at it as, let's sneak in a 100 basis points hike. And the market is not going to like that. So the trick here is, for the bulls, is to wait for the meeting to be out of the way and then initiate the summer rally. But a closing above 3,960 will be good. You get a close above that by an inch or so. And that's it by the end of the week. That would be bullish. When we look at the momentum indicators, the volume all supporting the bulls for now. The bears have to wait and see. They're still on the sidelines for now. What about the Qs? 30 minutes chart. What's going on here? I'm not going to even bother to identify resistance right now. I'm going to say we have a double top, at least from the perspective of the 30 minutes chart. We have negative divergence on the RSI. We have overextended reading. Some would call it overbought on the RSI, meaning the risk is to the downside, the risk for a pullback. If we get a pullback, are we going to go down all the way in a retest to 297.5? Perhaps, but we'll take it one day at a time. We're not going to say that the pop, the rebound is over until we see more damage. For that, here is the daily chart for the continuous contract for the Qs, the NASDAQ. The damage will happen when the chart loses 11,689 as support. Now that is a long way from here. We have to lose 12,207 first, so the bears once again on the sidelines. The bulls, they're still winning for now, but the trick is, can they close above 12,766 by the end of the week and secure that support line? That would be good. That would be bullish. And for now, the volume, the momentum indicators, all supporting the bulls. The IWM, small caps, 30 minutes chart, what's going on here? Again, I'm not going to bother identifying resistance for now because the risk is for a pullback for now. The pullback could go down in a retest to 180. It could go down to the support that I got, 178.60. The bottom line is the RSI is getting a little overbought, and it is a negative divergence for now. The risk is for a pullback. We'll see if the dip buyers show up in the morning and pick that up or not. What about the Dixie, the dollar index? What's going on here? Watch out. It's not dead. It's not over until it's over. For now, yes, the RSI, the MACD indicators are giving us negative readings, that we're seeing weakness in the momentum in the dollar. But that doesn't mean that it's over. If the dollar pops higher again, the rebound will take a pause. The rebound in the SPY, the Qs, the Dow Jones, the Russell, that will pause because the dollar is simply too high. We're seeing a lot of damage, folks, not only from IBM, Netflix, even Tesla reporting damage because of the exchange rate. And who called that, by the way? The answer is the mature guy in the room, gold. Gold refused to rally. It is waiting and waiting and waiting for the dollar to end its bluff. This is poker, high stakes, and gold is saying, hey, I don't believe the dollar. I don't believe that it's going down until it goes down for good, supported by a fundamental reason. And that reason could be coming up next week. But for now, if I'm reading the tea leaves, the most important support for gold is 1,685. If it loses that, forget about it. The dollar will make higher highs. But I doubt that we will see an impulsive move until the Fed meeting next week. If it is 75 and that's it, we wait till September. Watch how the dollar is going to top, how gold is going to rebound, and we see that summer rally. But if the Fed does the unlikely and goes with 100 basis points or more, then we'll see the dollar moving higher again and gold flushing down even further. What about Brent oil? 4 hours chart, what's going on here? It is consolidating, building that energy to pop higher. This is a bull flag consolidation, but we have elevated readings in the RSI, the MACD indicator, from a 4 hours perspective. So there is a risk for a pullback. What does that mean? The longer the chart consolidates without popping higher, the more likely the break will come to the downside, and Brent will lose 105.84 as support. So the pop has to happen by tomorrow. Otherwise, you will see Brent losing ground and losing 105.84. What about a daily chart for the 10-year yield? What's going on here? Again, when we look at the momentum indicators, they're suggesting a pop higher. But can we say comfortably that the 10-year yield will pop higher, significantly so, maybe above 3.25 all the way to 3.5 before the Fed meeting? I doubt it. All what we need for now, at least the bulls, what they need is consolidation. Wait and see. And then after the meeting, we see the 10-year yield moving down below 3%. That would be bullish. Otherwise, if we have a rally in the 10-year yield ahead of the meeting, that would put a lot of doubt in the rebound rally that we saw so far in the equities market. What about the TLT weekly chart? What's going on here? Got a little lift today, but still within the range of last week. The pop will not happen until next week. If it happens, it will happen if the Fed turns out to be dovish. By dovish, we mean 75 basis points, and that's it till September. About the VIX, what's going on here? It lost ground, the support of 24.29, but be careful here. I smell a trap that the VIX could curl around and recaptures 24.29 in the morning. And that will happen specifically if the dollar pops higher again. But the question becomes, will the bulls, the SPY bulls, pick up the dip if it happens and cause a rebound and back in the green again for the SPY? If that is the case, then we will see a confirmation in the VIX for the loss of 24.29, and that will be good news for market bulls. Here's a 4 hours chart for the VXN, still consolidating in a bear flag pattern, waiting and waiting for the next signal. If the drop doesn't happen soon enough, the opposite usually happens. We see a pop higher in the VXN. But for now, the assumption should be the bear flag will play out. And if the VXN goes down, that's good news for the Qs. But we just looked at the chart of the Qs. It looks prone for a pullback. We're talking about a pullback for a day or two. And if that is the case, then the VXN should move higher. So we have conflicting information here. On one hand, we have the Qs a little toppy from a 30 minutes, an hourly perspective, meriting a pullback. On the other hand, the VXN is also negative and showing a bear flag consolidation pattern. From a 4 hours perspective, the resolution could come by tomorrow. What about Apple, the daily chart? What's going on here? On track, moving higher, and it wants to reach the resistance of the trend line or 157. But usually the chart doesn't make it easy for you. Usually it pulls back before reaching the trend line or 157. The question is, if that happens, will Apple maintain 150 as support? That would be bullish. The bull's still in charge. But if it loses 150 as support, that would be a problem. If we have a weekly closing in Apple below 150. But again, the breakout up or down will not happen until earnings next week. Tesla, 30 minutes chart, what's going on here? The risk was for the downside that we could see a sell-off before the report comes out. But that didn't happen. We got a little pullback, got us all the way down, not quite to 720.11, but after the bell, and this is usually how Tesla performs in earnings season. We see premiums elevated for calls and puts, and the best trade is betting that Tesla will be flattish by the end of the week. And then next week, we see the real reaction for the stock. It usually works that way. I've been covering Tesla chart for over 2 years now in this program. Every earnings report so far, it has been behaving the same. The best strategy is to buy calendar calls or calendar puts before earnings, or if you're more sophisticated, you can use credit spreads or an iron condor betting that the stock will be flattish after earnings. And then the real reaction happens next week. For now, what is the risk here? I think Tesla will be in range, the support of 700, the resistance at around 766.5 until we get the Fed meeting out of the way. And then if we have a summer rally, Tesla will be included. If not, it's going to lose 700 as support, and that would be the beginning of another leg down for the name. Bitcoin, what's going on here? An hourly chart. So far, at least at the time of the recording of this video, we have a series of higher lows. So far, so good. The problem is, after Tesla came out with the news of dumping 75% of their Bitcoin holdings, it appears that the pattern is slowing down. It appears that it's making somewhat of a head and shoulder formation. It appears that we have negative divergence on the RSI. All of these are signs that we could see a pause in the pop in Bitcoin. Doesn't mean it's over. It's not going to be over till the chart loses 20,000 as support once again. And here are some bonus charts for you. We start with AMZN, Amazon, an hourly chart. We have a curved line of support. You can see the pattern of higher lows hitting over and over and over and over again. And then came the breakout. Now the RSI is becoming overbought, overextended. We have support at around 116.12, which happens to be a gap. If we have a pullback to work out some of these overbought readings, the chart can go down all the way to that support. And that would be good news for the bulls, by the way, because they don't want to see the name rallying too hard, too fast into earnings, because then the risk becomes to the downside. You want your stocks to be muted, even bruised and beaten into the earnings report, because if there is a surprise, we see that surge, that tsunami of short covering producing massive pops higher. Now, what about CCL, Carnival Cruises? This is an hourly chart, and again, you see the curved pattern, higher lows over and over and over again. But we have resistance at the gap at around 11, let's call it 11, it's actually 11 and 5 cents, but it acted as resistance before, and it appears so far today that it is acting as resistance because the name is down after the bell. If it goes down, the assumption is it should go down all the way to retouch the same pattern, which could coincide with closing a gap. That would be a downside of around 11 to 12%. What about the chart of Coinbase, COIN, hourly chart? You have another curve, a pattern of higher lows, and then comes the pop higher, the explosion pop. but it got out of hand. We have overbought readings in the RSI. What does that mean? The risk is for a pullback. If Coinbase pulls back, we have support at around 65.87. Now that's too much of a downside. It's only going to happen if Bitcoin loses 20,000 as support once again. But for now, the assumption is a pullback, maybe all the way to 70, and then we see a rebound higher. Unless Bitcoin loses 20,000. Then we'll see 65.87, maybe a little below that. And here's the last one, Netflix, NFLX, 30 minutes chart. What's going on here? It also got a little overhand. We have an overbought reading on the RSI. We have what it appears to be a double top pattern, which means the chart could pull back. If we have a pullback, we got support at around 209. We'll take it from there. If it rebounds, so far so good. If it doesn't hold, then we got bad news. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have, per usual, the initial jobless claims for the week. Now remember, bad news is good news. We need to see more job losses, not by a lot. This is what the Fed wants to see. We also have another important Philly Fed Manufacturing Index. When it comes to the earnings calendar, we have D.R. Horton, American Airlines, and Snapchat. And folks, with that, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.